Assalamualaikum and hi everyone. We are from Group 6 and we are going to present on the group statement of cash flow. My name is Hanina Suhaira binti Rushdan with matric number of 196509. I'm going to be the first presenter. Let's move on to the slide which shows the learning outcome of this chapter. In this chapter, we are going to learn on the statement of cash flows and consolidated statement of cash flows. Next, we get to know the treatment and the presentation of acquisition and disposal of subsidiaries in group statement of cash flows, preparation of group statement of cash flows under direct method, and preparation of group statement of cash flows under indirect method. Statement of cash flows. Let me give you a little bit definition of cash flows. What is cash flow statement? Cash flow statement is the movement in cash flows over the reporting period as classified under operating, investing, and financing activities. Let us proceed. The objective of cash flow statement. The objective is provide information that enables user to evaluate the changes in net asset of an entity. Next, it evaluates the enterprise ability to affect the amounts and timing of cash flows in order to adapt to changing circumstances and opportunities. Then, it's develop models to assess and compare the present value of the future cash flows of different enterprise. Then, to enhance the comparability of the reporting of operating performance by different enterprise because it eliminates the effect of using different accounting treatments for the same transaction and events. And finally, to evaluate the ability of the enterprise to generate cash and cash equivalent. It's provide information to the user of financial statement as to know whether the enterprise generate cash whether through the sale of its product or services or by getting loans by banks. It will affect the decision making of the user of financial statement. According to the MFRS 107, for each period for which financial statements are issued, an organization must create a statement of cash flows in accordance with the requirement of this standard and show it as an essential component of its financial statement. In other words, statement of cash flow is an integral part of financial statement. So the company must include statement of cash flow in the financial statement or otherwise it will be not complete. Features of statement of cash flow. In cash flow statement, there contain cash and cash equivalent. Cash consists of cash on hand and demand deposits. Demand deposit is a type of an account from which funds can be withdrawn at any time without having to inform the bank. Most of the checking and saving accounts are demand deposits. Meanwhile, for cash equivalent, it is a short-term, highly liquid investment that are readily convertible to non-amount of cash and which are subject to insignificant risk of changes in value. Investment normally qualify as cash equivalent only when it has short maturity, which is less than 3 months from the acquisition date. It also should be highly liquid, which means that they should be easily sold to the market and easy to find buyer of this investment. Convertible to non-amount of cash means that its market price should not subject to significant fluctuations. And there should be a very little risk of changes in their value, which means equity shares cannot be classified as cash equivalent. However, preference shares that purchased shortly before the redemption date can be classified as cash equivalent. Example of cash equivalent would be commercial paper, treasury bills, and short-term government bonds with a maturity date of 3 months or less. Next, in cash flow statement, according to MFRS 107, the statement of cash flows shall report cash flows during the period classified by operating activities, investing activities, and financing activities. Operating activities means that the amount of cash flows arising from the activities a business use to produce net income. Basically, the cash generated from doing what the company in the business do. It also gives the information on the cash generated by sales and production activities. For example, in cash receipt, the operating activity receive cash from the sale of goods and the rendering of services, receive cash from royalties, fees, commission, and other revenues. And meanwhile, for the cash payment to supplier for goods and services, and cash payment to and on behalf of employees. In investing activities, arise from the business buying and selling of long-term assets or other investment other than cash equivalent. It shows how the business utilize the cash. For example, cash payments to acquire or cash received from the sale of property, plant and equipment, PPE, intangibles and other long-term assets. Next, the cash payment to acquire and cash received from the sale of equity or debt instrument of other entities and interest in joint venture. And finally, for financing activity, it is an activity that results in changes related to long-term debt and equity financing. It's involved in obtaining and repaying of financial resources from owners and their provider of concurrent capital on which the provider receives a return. For example, cash proceeds from issuing shares or other equity instrument, cash payment to owners to acquire and redeem the entity shares, and the cash repayment of amounts borrowed. There are two methods of generating statement of cash flow. According to MFRS 107, an entity shall report cash flow from operating activities using either direct method and indirect method. Direct method whereby major classes of gross cash received and gross cash payment are disclosed, which means that under the direct method of operating activities, it lists the cash received and cash payments made during the accounting period. The cash flows are subtract from the cash inflow to calculate the net cash flow from operating activities. Next, for indirect method, profit or loss is adjusted for the effect of transaction of non-cash nature, any deferral or accrual of past or future operating cash received or payments, and item of income or expense associated with investing or finance cash flows. It means that the indirect method, it begins with the net income before tax from the income statement, and the income statement adjusted for changes in the asset and liability accounts on the balance sheet by adding to or subtracting from net income to derive the cash flow from operations. The cash flow from financing and investing activity section will be identical under both indirect and direct method. So only the difference between direct method and indirect method only presented under operating activities. and this will explain details further. Under cash flow statement also contain non-cash transaction. Non-cash transactions are investing and financing related transactions that do not involve the use of cash and or cash equivalent. For example, when a company buys an asset or incurs or an expense, but instead of using cash, the company writes a promissory note or takes over existing loan. So the company involved in non-cash transaction. Non-cash investing and financing shall be excluded from the statement of cash flow and shall be disclosed elsewhere in the financial statement or in separate schedule or in a way that provides all relevant information about the transaction. These are excluded because many investing and financing transactions do not give direct impact on current cash flow, even though it affects the capital or asset structure of an entity. The non-cash investing and financing will be reported at the bottom of the statement cash flow, or it will report in a note related to the cash flow of statement of cash flow. Example of non-cash transaction. First, issues 250,000 share of common stock to purchase building. It an exchange between common stock and building. So it provide it provide journal entry, debit building, credit common stock. And other example will be second, converted 12% of bonds to 50,000 share of common stock. And next, exchange land in Steadfast for land in Bedford. If this example does not involve cash and cash equivalent. And look at these figures, it shows that where the non-cash transaction or non-cash investing and financing will be presented, which it will be present at the bottom of the statement of cash flow. These are the reconciliation of cash, and under it will be the non-cash of investing and financing transaction. There are 4 steps of preparing statement of cash flow. First, prepare the operating activity section by converting the net income from accrual basis to a cash basis. Next, prepare the investing activity section by presenting cash activity for non-current asset. This step focuses on the effect changes in non-current asset have on cash. Then prepare the financing activity section by presenting cash activity for non-current liabilities and owner's equity. These steps focus on the effect changes in non-current liabilities and owner's equity have on cash. And finally, reconcile the change in cash. Each section of the statement of cash flow described in step 1, 2, and 3 shows the total cash provided or used by each activity. Step 4 confirms the net of these changes equates to the change that cash derived from balance sheet. This is a statement of cash flow under direct method. As you can see, it's separate with 4 sections, which are operating activities, investing activities, financing activities, and the reconciliation of the changes of the cash. Next will be this format shows the statement of cash flow under indirect method. It also applies the same as direct method, which shows the same operating activities, investing activities, financing activities, and the reconciliation of changes of the cash, except that under operating activities, It started with the net income before tax and some adjustment. Meanwhile, indirect method, it begins with the cash inflow and cash outflow of the company. Let us proceed to look into more details. Comparing cash flow under operating activities, as we can see on the left side will be direct method and the right side will be under indirect method. Cash flow under direct method provide cash inflow and cash outflow. Example of cash inflow is the cash receipt from the sale of goods and services, cash receipt of royalties, fees, commission and other revenue, interest and dividend, and cash receipt contract held for dealing or trading purposes. And these cash inflows will be subject with cash outflow such as cash payments to supplier of goods and services, cash payment to employees for services, cash payments to government for income taxes, cash payment to lenders for the interest, cash payment on contract held for dealing or trading purposes in order to get net cash flow under operating activities. Meanwhile, on the right side, indirect method, it begins with the net profit or loss before tax, then adjustment for changes in stock, debtors and creditor, adjustment for non-cash item, adjustment for all other items which cash effect are investing or financing cash flow, which produce operating profits before working capital changes. And to get the net cash from operating activities, calculate the changes of working capital. For example, increase, decrease in trade or and other debtors, increase, decrease in stocks, increase, decrease in trade and other creditors. In between direct method and indirect method, accounting standard encourage companies to report cash flow under direct method. However, most companies favor the indirect method as it is easier and low in cost. It is simple to prepare cash flow statement under indirect method using information from the other two common financial statement such as in the income statement and the balance sheets. It also focuses on the differences between the net income and net cash flow from operating activities, meaning that it makes more useful to relate the statement of cash flow and the income statement and balance sheet. The accounting in indirect method, the accounting system does not easily generate information needed to use the direct method. For consolidated statement of cash flow will be presented by the next presenter, Jennifer.
Hello everyone, my name is Jennifer Jelawa Ananjunathan and my metric number is 196514. Now I will be presenting on the consolidated statement of cash flow. So what is group statement of cash flow? It forms an integral part of the group accounts and it is viewed as cash flow of one entity represented by all the companies in a group, where the cash flow inflows and outflows are aggregated to form one single cash flow statement. The principle involved in preparing cash flow statement either in a single entity or group cash flow statement is the same, except that in a group cash flow statement may have additional items that are normally found in the group accounts, such as minority interest, acquisition and disposal of subsidiary, associate and joint venture. So that is regarding group statement of cash flow. Next, we will look into non-controlling interest, or we can call it as NCI. Under NCI, the balance in NCI will only change due to, as you can see here, there are two transactions. The first one is the NCI is in the profit of the current year of a subsidiary. And the second one is the dividend paid by a subsidiary to the shareholders of the NCI. So these are the two transactions that change the balance in NCI. For transaction A, which is the NCI is in the profit of the current year, the proportion of the profit in current year in the subsidiary will have no effect on the consolidated statement of cash flow, and it has nothing to do with cash and cash equivalent. As for transaction B, which is the dividend paid by the subsidiary to the shareholders of the NCI, it will show the results in the outflow of cash. Next, I will be talking on the changes in shares, or we can refer it as additional shares. There are two ways whereas the company can get the additional shares. The first is issue new shares. If the company issue new shares, they will have to recognize it as cash received from, and they shall present this into the inflow of cash to the group. The second method is the repurchase of shares, sorry, and they shall recognize this as the cash paid. Thus, it shall be presented as outflow of cash from the group. Both issue new shares and repurchase of shares are presented under the financing activities. So these are the regarding non-controlling interests. For the next slide, we will look into the illustration and how should we answer for this illustration. From the example, A. Berhad holds 70% of B. Berhad. Below are the partial consolidated income statement, consolidated statement of changes in equity, and income statement of B. Berhad, and statement of changes in equity of B. Berhad for the year ended 31 December 2020. As you can see here, this table shows the information, the amount for the consolidated income statement, and also the information on the statement for the income statement of B. Berhad. So these are the information. For the next slide, it shows the information on the consolidated statement of changes in equity and also the information on the statement of changes in equity of B. Berhad. Okay, these are the question, and next we will look into on how to answer for the illustration. For the first method, as you can see here, the first method is direct method. How do we do this direct method? Under the cash flow from financing activities, we should put the dividend paid to minority shareholders, and the amount is 3.75. How do we get this 3.75? Is by calculating 30%, which is the percentage of the non-controlling interest, multiply with 12.5. The 12.5 is the total dividend which can be obtained from the statement changes in equity for B. Berhad. So this is how we answer for if we use the direct method. For the next method which is indirect method. Under indirect method, it is also same as what we did in direct method. Just that in indirect method, we have to add on the profit before tax, which will be put under the cash flow from operating activities. As you can see here, the amount of the profit before tax is 625,000. How do we get this amount, 625,000? We can get this amount from the previous slide, which is stated under the consolidated income statement. And then after we put the amount of the profit before tax, then we will put the amount of cash flow from financing activities. Under the cash flow from financing activities, we should put the dividend paid to minority shareholders. The amount of the dividend paid to minority shareholders we will do as how do we calculate in previous slide, which is under the direct method. As you can see here, the dividend paid is 3.75. The formula is 30%, which is the percentage of the NCI, multiply with the total dividend. The total dividend is 12.5, which can be obtained from the previous slide in the statement changes in equity for B. Berhad. That's all from my part. Next, I will pass this presentation to the next presenter. Thank you.
Okay, thank you, Jennifer. My name is Aisha Financing Othman. My matric number is 196939. Now I will explain about associates and joint venture. For the associates and joint venture, the equity method has been applied in the group account in the respect of investment in associates and joint venture. The group statement of cash flow shall reflect on the cash flow between itself and investee, which is associate and joint venture entity. For investment in associate joint venture, account balance will only change due to first, group interest in the current year's profit of the associate company. The proportion of the current year's profit in the associate will have no effect on the consolidated statement of cash flow and nothing to do with the cash or cash equivalents. Second is dividend received. result in the flow of the cash, and the effect of dividend received depend on the method that used by the company. Next is I will explain about treatment of for interest, advance, and loan. For interest paid and interest received, general rules is on operating activities because these enter into determination of profit or loss, especially if the interest is received from the receivable or payable that related to revenue producing activities of the entity. But alternatively, another option is interest paid may be classified as a financing cash flow because it's a cost of obtaining financial resources. For example, interest from long-term debt and bond payable. Interest received may be classified as an investing cash flow because it's a return on investment, such as debt securities that investment are raising from investment activities. But for if financial institutions, interest paid and interest received are usually classified as operating cash flow. Okay, for loan and advance, cash, loan, and advance given to associates and their subsequent repayment are classified as investing cash flow. Okay, similarly to cash advance and other borrowings from associate will classify as the financing cash flow. Okay, next is how do we classify the cash transaction that related to the dividends? As a rule, dividend paid is on financing activities because it is a cost of obtaining financial resources. So, when you issue the shares, there is a equity financing and you pay the dividend coming from those investments paid by the shareholder. So, it classified as financing activities. For non-control interest, NCI, and shareholders, they involve in outflow of cash, which will be also disclosed as financing activities. But alternatively, if it may be classified as operating cash flow in order to assist the users to determine the ability of entity to pay dividend out of operating cash flow. Parents does not entail an outflow of cash for the groups. For the dividend received, as general rules, dividend received is on operating activities because this enter into determination of profit or loss. But another alternative, it may be classified as an investing cash flow because it is a return on investment. When you invest in the form of share or stock, you will be receiving dividend in return, right? So it will classify as investing cash flow. And the associate does not entail an outflow of the cash for the groups. So this is an illustration too. The question is A Berhad holds 70% of B Berhad and 20% of C Berhad. Below are the partial or consolidated income statement, CIS, consolidated statement of changes in equity, CSCE, and income statement of C Berhad and statement of changes in equity C Berhad for the year ended 31st December 2020. So there is a CIS and C Berhad. They have operating profit, share of profit from associates, profit before tax, and profit after tax. This is a CIS and CSCE. There is a tribute to shareholder of parents and minority interest. For the CSCE, there is a beginning return profit, profit for the year, dividends, and ending return profit. So this is the answer for indirect method. First, we need to identify the cash flow from operating activities. Because it is an indirect method, so we need to start with the profit before tax. So profit before tax is 642.5 thousand. And we need to less non-cash item, which is share of profit from associates, 17.5 thousand. Then we need to identify the cash flow from investing activities, which is dividend received from associates. Because of A Berhad holds 20% of C Berhad, so we need to multiply 20% with the dividends 12,500, which and we get 2.5 thousand. For indirect method, it's just a simple method because in the operating cash flow, we no need to start with the profit before tax. So for this case, we can directly go to the investing activities which is we get dividend received from associates 2.5. Okay, now I will explain about cash flow from non-current asset held for sales and discontinued operations. Okay, for the non-current asset held for the sales, subsidiary classified as a held for sales as disposal group that shall continue to be considered in the parent's group account. All its assets shall be combined and presented as a single line item, and same as all liabilities as single line item in the current liabilities. The presentation of the non-current asset held for sales and liabilities attributable to the non-current asset held for sales has no effect on the group's cash flow. Okay, thus they should be eliminated by the contra adjustment to the net changes in the representative asset and liabilities. Okay, for the discontinued operation DO, under IAS 7, require an entity to include all its cash flow in the statement of cash flow, that including those generated from continuing and discontinuing activities. When provided a specific condition are met, the disposal group may qualify as discontinued operations. The measurement of the disposal group is lower than the carrying amount and fair value and less cost to sales. Okay, there is a two-way that we can be achieved. First is presentation in the statement of cash flow. This means that the net cash flow from each item of activity, which is operating, investing, and financing, derived from discontinued operation, are presented separately in the statement of cash flow. Okay, the second is a presentation in the notes, which means cash flow from discontinued operation included together with the cash flow from continuing operations in each line item in the statement of cash flow. The net cash flow relating to each item of activity, which are operating, investing, and financing, that derive from discontinued operation and then disclosed separately in the notes to the financial statement. Okay, that's all from me. I will pass this presentation to next presenter, Wano Atira.
Thank you, Ain. So before that, I am Wana Atira binti Wahmat Masyukri. The metric number is 195833. I will continue on acquisition of subsidiaries. Acquisition of subsidiaries can increase group total asset and liability. It will also decrease the group cash by the amount paid to acquire the subsidiaries. Based on MFRS 107, it required that aggregate cash flow arising from acquisition and disposal of subsidiaries or other business unit should be presented separately and classified as investing activity. The important requirement for disclosure in calculate the cash flow acquisition is first, the total purchase consideration, and the second one is the portion of purchase consideration discharged by means of cash or cash equivalent. To make it clear, here we go to the illustration 3. Assume that A Berhad acquired another subsidiary D Berhad for another 80% with cash purchase consideration of 125,000 during year 2020. At the date of acquisition, D Berhad balance sheet as shown below, which is in the debit side, we have share capital, return profit, trade creditor, and dividend payable. In the credit side, we have building, equipment, inventory, and cash. This is the solution of illustration 3. The total asset is 250,000 minus by the total liability of trade creditor and dividend payable by 100,000. We get the net asset of 150,000. Next, we minus the minority interest, which is 20% of the net asset, and get the 120,000. Next, we add 5,000 of goodwill, which is balance sheet figure. Thus, the total cash purchase consideration is 125,000. Will be deduct the cash available in D Berhad, which is 12,500. and we get the cash flow on acquisition, which is 112,500 ringgit as required by MFRS 107 paragraph 42. The amount of cash that need to be present in the consolidated cash flow statement is 112,500 ringgit. So this is the way where we present in the cash flow statement, which the acquisition of subsidiary of 112,500 ringgit is under the cash flow from investing activity. So I will pass to Fatana to continue the presentation.
Thank you, Wan. My name is Nurul Fatana binti Muhammad Zain. My metric number is Y97853. I will continue with disposal of subsidiaries. When parent dispose one its subsidiaries, it will decrease group total assets and liability. It also will increase the group cash by the amount of cash received from the disposal. Cash positions of the group is affected only by the cash flow involved in the transaction of disposal. The net cash flow will be the disposal considerations received in cash and cash equivalent less any cash and cash equivalent in the subsidiary disposed. Under MFRS 107, paragraph 39, requires that the aggregate cash flow arising for acquisitions and disposal of subsidiaries or other business units should be presented separately and classified as investing activities. For disclosure requirement, the standard requires the summary on effects of the disposal to be disclosed. For the first disclosure requirement, the parent should disclose the total disposal price that they are received. Second, the portions of disposal price received in cash or cash equivalent. Third, amount of cash and cash equivalent in the subsidiary disposed. And lastly, the amount of other assets and liability in the subsidiary disposed. Now I will proceed with illustration 4 to more understand. Assume that Eberhard disposed one of its subsidiary, which is Eberhard, during the year 2020. Eberhard acquired 80% of Eberhard. Cash considerations of 200,000 was agreed for disposal. At the date of acquisitions, Eberhard balance sheet as below. Share capital 125,000, return profit 25,000, trade creditors 63,000, dividend payable 37,000. So the total liability and equity is 250,000. So for the parts of the total asset, goodwill 100,000, equipment 85,000, inventory 50,000, and cash 15,000. So the total asset which is 250,000. To solve the solutions of illustration 4, we need to take cash consideration, which is 200,000, minus with cash available in Eberhard, which is 50,000, and we will get cash flow on disposal. Under MFRS 107, paragraph 42, the amount of 185,000 need to be disclosed in the consolidated cash flow statement. So as below, they show the partial consolidated cash flow statement Eberhard and Group for the year ending 31st December 2020. So disclosure of subsidiary, which is 185,000, need to put under the cash flow from investing activities. Okay, now I will continue with change in interest in subsidiary without loss of control. Under MFRS 107, cash flow arising from change in ownership interest in a subsidiary that do not result in a loss of control shall be classified as cash flow from financing activity. Change in ownership interest in subsidiaries not involve loss of control may occur when parent purchase additional equity interest in an existing subsidiary or parent dispose some equity interest in an existing subsidiary without loss of control. The effects of the change in the interest are accounted as equity transaction between parents and NCI, and it will take in the statement of change in equity. Okay, now I will continue with preparations of consolidated statement of cash flow. As we know, to prepare statement of cash flow, there are two methods, which is direct methods and indirect methods. The way we prepare consolidated statement of cash flow is same with the single company that we prepare before. So the difference between direct methods and indirect methods is cash flow from operating activity. In direct methods, we will direct take cash received from customers, cash paid to supplier, cash paid to employer and other expenses. While in direct method, we will take from the profit before tax and we need to adjust depreciations, amortizations of intangible assets, and payments of assets or investment, allowance for doubtful debts, profit or loss on disposal of assets or investment, share of profit or loss of associate, interest income or expenses, dividend income, and we will get operation cash flow before working capital change. So from that we need plus and minus, change in working capital, change in inventory, change in trade and other receivable, and change in trade and other payable. So from that we will get cash generated from operation. When we get both methods, cash generated from operation, we need to minus with interest paid and income tax paid to get net cash from operating activity. And then for the cash flow from investing activity and cash flow from financing activity, both methods is same. So for the cash flow from investing activity, there are purchase of property, plant and equipment, proceed from cash sale of PPE, purchase of investment, acquisitions of subsidiary, disposal of subsidiary, dividend received from associated, and interest received. We will get net cash flow, the item we can get from consolidated statement of financial position under current liability and equity. And from then, we will get net cash used in financing activity. So to get net increase in cash and cash equivalent, we need to plus from net cash from operation activity, net cash from investing activity, and net cash used in financing activity. So from that, we need to put cash and cash equivalent at the beginning of the year. We can take it from the considered statement of financial position, which is the calculation is operating balance minus cash and bank balance and minus bank overdraft. Therefore, we will get cash and cash equivalents at the end of year. That's all for me and I will pass to Wen to continue the presentation.
Thank you, Fatana. So I will conclude on this chapter. This chapter is referred to MFRS 107. Statement of cash flow show how much cash is generated and used during a given time period. Consolidated statement of cash flow is just the same as we do for the individual company, with a specific adjustment for the related item, as what we highlighted before this, such as cash paid to NCI, cash received from associate, and acquisition and disposal of subsidiaries. Next, the parent of company will prepare the consolidated statement of cash flow, which is reflect the cash flow of the groups. And finally, a consolidated statement of cash flow aggregate cash flow from financing, investing, and operating activity across all majority-owned companies that are legally separate business. So I think that's all from us. Thank you.